Okay, let's unpack this. We tend to think that changing our lives requires these massive cinematic moments.
Oh, absolutely.
Like, quitting a toxic job in a blaze of glory, or selling a startup, or, I don't know, hitting some financial lottery.
Right, the big thunderclap moments.
Yeah, exactly. But today's source material, which is a set of presentation notes titled The $100 Path to Financial Autonomy, it basically argues the exact opposite.
It really does.
And the mission for this deep dive is to completely demystify wealth building. We're really tailoring this specifically for the listener who feels entirely overwhelmed by the whole concept of investing.
Which is most people, honestly.
Right. Or people who just assume that financial freedom is strictly reserved for, high earners or tech founders, or people who spend all day staring at like 6 different stock monitors.
Yeah, the Wall Street types. And what's fascinating here is that the source material challenges our most foundational perception of money. It suggests the secret to financial autonomy isn't a massive salary. It's not about finding the next big cryptocurrency before anyone else does.
Thank goodness.
Right. It is about the quiet, almost boring compounding of incredibly small, consistent actions over a lifetime. It operates on a timeline that completely defies our modern obsession with instant gratification.
It really does. And the core unit we're talking about today is beautifully, almost laughably small.
Yeah.
A single $100 bill.
Just one.
Every month. That is it.
Yeah.
If we map that onto daily life, we are talking about highly disposable income. I mean, $100 is a dinner out for 2.
Yeah, easily.
Or a couple of ride shares you took because you were running late.
Right.
Maybe it's those 2 or 3 streaming subscriptions you signed up for to watch, like one specific show.
Well, I've done that.
We all have, and then you completely forget to cancel it.
Exactly. It's money that easily slips through the cracks of a normal busy life.
Yeah.
It is the absolute definition of invisible friction in our budgets. Because we don't respect $100 the way we respect $1,000. We just let it bleed out.
We really do.
Yeah.
But this is where the map doesn't seem to map onto reality for me.
Okay, how so?
Well, if it is just a forgotten subscription or a couple of Uber rides,
Yeah.
how does redirecting something that minor structurally change a human life? I mean, it feels completely disproportionate. I just can't imagine a scenario where skipping a few lattes fundamentally alters my destiny,
That skepticism is universal. It really is. And it's the exact illusion we fall for.
Okay.
We judge the outcome by the size of the initial input. But the core premise of our source material reveals exactly what happens when you harness that small input over a vast stretch of time.
Right.
If you take that exact $100 every single month for 40 years and you automate it into a broad market index fund, it creates what the author calls an absolute divergence in how your life plays out.
Wow.
It literally splits your timeline into 2 completely different realities.
Hold on. Wait. Before we jump into decades of time and alternate realities, you just dropped the phrase broad market index fund.
I did, yeah.
And for the listener whose eyes just glazed over, and frankly, mine did a little bit too.
That's completely fair.
What actually is that?
Yeah.
If we're really demystifying this, we need to understand the vehicle.
That is a crucial point to clarify. Because when people hear the word investing, they usually picture a frantic trader yelling on Wall Street.
Right. Trying to guess which single company is going to release the next big product.
Exactly. That is stock picking, and it is incredibly risky. An index fund is the opposite of that.
Okay.
Instead of trying to find the needle in the haystack, meaning trying to guess which single company will win, you just buy the entire haystack.
Oh, I see. So instead of putting my $100 into one tech company and basically praying it doesn't go bankrupt,
Right.
I'm buying a microscopic fraction of hundreds or even thousands of the biggest companies in the country all at once.
Precisely. You are buying a tiny sliver of the overall economy.
Wow, okay.
If one company fails, another one thrives. And over long periods of time, the general trajectory of human commerce and innovation trends upward.
That makes sense.
Yeah, the index fund just automates this diversification. You don't have to read earnings reports, you don't have to watch the financial news, and you don't have to guess. You just ride the overall upward momentum of the market.
Okay, that makes the mechanism much clearer.
Good.
But to understand how that automated $100 creates this absolute divergence, we have to look at how this journey actually starts.
Yes, we do.
Because, according to the text, the beginning is easily the hardest part.
Oh, without a doubt.
It is this brutal period where human psychology violently clashes with mathematical reality.
It is a severe test of patience. The author is very clear that the initial phase breaks almost everyone.
Really?
Yeah. We have to look at the math for the first decade to understand why.
Let's do it. Let's lay out the numbers for year 1 to year 10.
Okay.
The source assumes a historical average market return of about 8%.
Which is a pretty standard long-term assumption, yeah.
Right. So you set up the automation. The $100 leaves your checking account every month. You do this faithfully, without fail, for 10 entire years.
A full decade.
At the end of that decade, your total physical contributions, like the actual cash you scrape together, is $12,000.
Right. And factoring in that 8% average historical return, the total value of your portfolio after those 10 years is roughly $18,000.
You know, looking at those numbers, it feels incredibly frustrating.
It does.
$12,000 in, $18,000 out. You have made about $6,000 in profit after an entire decade of discipline.
It's a tough pill to swallow.
Let me give you an analogy for how this feels.
Please.
Imagine you decide you want to get in shape. You wake up at 5 in the morning, you eat boiled chicken and broccoli.
The worst.
You go to the gym, you sweat for an hour every single day for an entire year. And at the end of that grueling year, you step on the scale and you've lost exactly 1 pound.
You would be furious. You would feel completely cheated by the system.
Exactly.
And that feeling of betrayal is exactly why the source material labels this the boring phase.
The boring phase.
Yeah. Human beings are incredibly bad at processing delayed, non-linear rewards.
Oh, for sure.
We are wired to expect immediate feedback. When we expend effort, we expect a proportional result today.
Right. I put in the work. I want the reward now.
Exactly. When the effort doesn't immediately match the output, our instinct is to assume the system is broken.
Which explains the critical, sobering statistic highlighted in the text. This perceived mismatch is why 90% of people quit during this phase.
90%.
They look at the $18,000, they look at the 10 years of skipping dinners out, and they just cash out.
Yep, they buy a slightly nicer car, or they take a luxury vacation.
Right.
And their timeline snaps right back to the default reality of living paycheck to paycheck.
Right.
But the text argues that these people fundamentally misunderstand the purpose of the first decade.
Okay, how so?
Well, the aha moment of those first 10 years is realizing that you aren't actually building a massive financial balance yet. That is a secondary outcome.
Interesting.
The primary goal is that you are building the habit engine.
The habit engine, meaning the psychological conditioning of living on less than you make.
Yes. You are proving to yourself that you can live without that $100.
Right.
You are rewiring your nervous system to tolerate automation and to just ignore the money leaving your account. You are building the invisible behavioral infrastructure that makes everything else possible.
I see.
The $18,000 isn't the prize. The discipline is the prize.
Okay, so I've spent a decade building this habit engine. I've suffered through the boredom, and I haven't touched the money.
You survived.
I survived. But habits only stick if there is eventually a tangible payoff. When does the math actually start rewarding this discipline?
That brings us to the second decade, years 10 through 20. This is where the machinery of compound interest actually begins to show its strength.
Let's run the numbers for this next milestone. You keep the habit engine running, $100 a month. By year 20, the total amount of your own physical cash that you've invested is $24,000.
Right.
But the portfolio value has jumped to roughly $58,000.
Now, stop and evaluate the relationship between those two numbers.
Okay.
24,000 and 50,000 total. You have crossed a critical mathematical threshold in this phase.
Which is?
This is what the source calls the turning point. Because at this specific stage, your money is now earning more annually than your actual annual contributions.
I want to make sure the mechanics of that are crystal clear.
Sure.
I am putting in $1,200 a year, but how is the money earning more than that?
This is the beauty of dividend reinvestment and compounding. The companies in your index fund are generating profits, and they pay out a portion of those profits to you, the shareholder. Because everything is automated, you aren't cashing those profits out to buy groceries.
I'm not seeing that money in my checking account.
Exactly. The system automatically uses those dividends to buy you more tiny slivers of the market.
So my money is essentially buying more workers, and those new workers are generating their own profits.
Exactly. Your $58,000 portfolio, growing at an average of 8%, is generating over $4,600 a year in growth.
Wow.
And you only put in $1,200. The balance of power has officially shifted. The mathematical engine is now pulling more weight than your physical labor.
That sounds incredible on paper, but I have to look at this realistically.
Okay.
A $58,000 balance at year 20 feels like a financial no man's land.
Sure.
It's certainly a nice chunk of change, but I'm definitely not retiring on that. I can't move to a private island.
No, you can't.
So what does this actually mean for the listener's day-to-day life? Is the point just to keep waiting for another 20 years?
It is absolutely not about retirement at this stage, and it is not just about waiting. The source makes a brilliant distinction here regarding the real-world utility of that money.
Okay.
The benefit at year 20 is about having a buffer. And having a buffer fundamentally shifts your physiological and psychological relationship with risk.
A shift in my relationship with risk. How does a $58,000 buffer change how I operate on a random Tuesday afternoon at work?
Consider the psychological weight of living without a net.
Oh, it's heavy.
When you are living right at the edge of your means, every single decision is driven by a subtle, underlying survival fear.
Yeah.
Your cortisol levels are constantly elevated. If your manager is toxic, you endure the abuse because missing a single paycheck means missing rent.
Right, you're trapped.
If the transmission on your car blows out, it is not just an inconvenience. It is a full-blown household crisis that requires taking on high-interest credit card debt.
You're just reacting to life's emergencies with pure adrenaline. It's like a constant low-level panic.
But when you have a liquid safety net of nearly $60,000 sitting quietly in the background,
Yeah.
that panic evaporates. You aren't operating in fight or flight mode anymore. The sources specifically contrast this state with peer burnout.
Peer burnout. Like watching colleagues who make the exact same salary as you, but who didn't build the habit engine, just grinding themselves into dust.
Yes. They are still trapped in that survival fear, aging rapidly under the stress. But you, with your buffer, begin making completely different life choices.
Like what?
Well, you negotiate harder for a raise, or you push back against unreasonable demands because you know deep down you have a runway.
Right, you have that security.
You might even take a slightly lower paying job that offers a much better quality of life. The financial buffer acts as a shock absorber for existence. It lowers your daily stress baseline.
It is the physiological benefit of autonomy. And that calm, calculated mindset seems like the perfect foundation for what happens next. Because as we transition into the final 2 decades of this timeline, the math completely leaves human intuition behind it.
It really does. This is where our brains fail to grasp exponential growth. We understand linear progress, 1 step, 1 yard.
Right.
We do not naturally comprehend the explosive momentum of compounding.
Here's where it gets really interesting. Let's look at the final 2 decades, the snowball.
Okay.
We keep the $100 habit going, never increasing it. By year 30, your total invested cash over 3 decades is $36,000. But the portfolio value, it's roughly $150,000.
The acceleration is staggering.
And it doesn't stop. Let's push it to the finish line. The year 40, your total physical investment, the actual money missing from your checking account over your entire working life,
Yeah.
is $48,000.
Right.
But the final portfolio value is an incredible $350,000, or even slightly more, depending on exact market variations.
I want to zero in on the most arresting fact from the source material regarding this final phase.
Please do.
It is a percentage that forces you to reevaluate how you view time and effort. Over 85% of your final net worth is generated purely in the final decade.
Let's break the math down on that because it's almost unbelievable.
It is.
Out of a $350,000 nest egg, my physical deposits were only $48,000.
Yep.
That means over $300,000 of that final balance was generated completely by the mathematical system.
Exactly. And the vast majority of that leap happened between year 30 and year 40.
I want to replace the cliches we usually hear about this. It's not a runaway train. It is purely mechanical.
Right.
At year 30, you have $150,000. 8% growth on that balance is $12,000 in a single year.
Which is huge.
That means the interest alone is contributing 10 times more money to the account than my physical $100 deposits.
Exactly.
It is like rolling a snowball down a long hill.
Yeah.
For the first 10 years, you're pushing it with your own hands, and it's exhausting.
So exhausting.
But by year 30, the snowball has so much mass that as it rolls, its own massive surface area is picking up more new snow in a single rotation than you could have ever pushed by hand.
That is the perfect way to visualize it. Time and mass have taken over the equation. The system is doing practically all of the heavy lifting.
Which brings me to the obvious glaring question.
Okay, what is it?
If the math is guaranteed by time,
Right.
if the system is just a simple automated index fund that anyone can set up on their phone in 10 minutes,
Yeah.
and it literally operates on the cost of a few forgotten subscriptions, why isn't every single person walking around with a $350,000 safety net?
That is the ultimate question. If the mechanics are so simple, what is the catch?
Right. What is the honest cost of this path?
The source is very blunt about this reality. The hard part isn't the math. As we've seen, the math is entirely automatic. A computer server handles it.
Yeah.
The true cost of this path is enduring human friction.
Human friction, meaning life constantly trying to derail the automation.
Exactly. The spreadsheet assumes 40 years of uninterrupted peace, but life is violent and chaotic.
It really is.
Enduring human friction means passing through massive global market downturns. It means logging into your account in a year like 2008 or 2020
Oh, well, yeah.
and seeing your life savings drop by 30% in a matter of weeks and having the emotional regulation to do absolutely nothing. You cannot panic and sell.
It also means surviving deeply personal life interruptions. Losing a job, having medical emergency, going through divorce,
Right.
or having your water heater explode in the middle of winter.
And perhaps most difficult of all, it requires fighting the constant everyday temptation of lifestyle creep.
Oh, lifestyle creep is real.
It is the temptation to look at that growing balance when you are tired and stressed and say, you know, I've been working hard. My neighbor just bought a new SUV. I deserve to cash out a little bit to remodel my kitchen.
It requires decades of undefeated emotional regulation.
Yes, it does.
Every single month for 40 years, you have to silently agree to defer a tiny amount of pleasure. You have to actively choose the invisible future over the highly visible, highly validating present.
And functionally, that is incredibly hard for human beings to execute.
It takes a monumental amount of quiet discipline.
It does. The math is simple. Surviving the human friction is the real achievement.
I want to circle back to the visualization the source provides at the very end of the notes, because it grounds everything we've talked about.
Okay.
It paints a picture of someone simply walking down the street in a peaceful neighborhood, entirely free from financial panic.
It's a great image.
It reminds the listener of the core takeaway here. $100 a month doesn't make you overnight rich. You aren't buying a mega yacht.
Yeah.
What you are buying is your future self's ability to have choices.
That is the perfect synthesis of the entire text. You are purchasing autonomy. You are buying the freedom to say no to circumstances you don't want to endure.
Right.
And the freedom to absorb life's inevitable disasters without them destroying your world.
So we started this deep dive by talking about how we expect life-altering change to be a thunderclap, like a cinematic moment.
Yeah.
But we've unpacked the mechanics, and we've seen that radical change is really just a microscopic habit, automated through an index fund, compounding quietly in the background until it carves out an entirely different reality.
It is a complete divergence in your life's trajectory, built entirely on the foundation of unglamorous consistency.
Which leaves us with a really fascinating question.
Okay.
If time and compounding do over 85% of the heavy lifting in a 40-year financial equation,
Right.
how might that exact same principle apply to other areas of our lives?
Oh, wow.
Think about the mechanics of the snowball. If you applied the $100 a month level of quiet, unglamorous consistency to a personal goal,
Like what?
like learning a new language, or mastering a difficult craft, or intentionally building a deep relationship, and you absolutely refuse to quit during the frustrating, boring phase,
Yeah.
what would your psychological year 40 look like?